Welcome to Zen and the Art of Real Estate Investing. What if you could learn from experienced real estate investors, find out what got them to where they are now, get insight into their daily habits, and take these insights to inspire your own growth? Each week, Jonathan Green shares an in-depth look at the mindful approach to real estate investing. Jonathan is a lifelong real estate investor, advisor, and coach, as well as the founder and team leader of Streamlined Properties. Whether you're looking to start from scratch, get to the next level, or just for a straightforward and honest approach to real estate investing, Jonathan seeks to provide a free mentorship program you can take with you anywhere. Now, here's Jonathan.
Even 156 episodes in, we can still break new ground in real estate investing, and we're going to do that today. My guest is Alex Cartwright. He is the principal of Hotel Shift. We're going to talk today about transforming underutilized hotels into vibrant apartment ecosystems. This is a great show, and Alex is a really smart guy. He's a professor of economics, and this one goes deep. You're going to learn a lot about economics and hotels and conversion. Let's go. This is episode 156 of Zen and the Art of Real Estate Investing with my guest, Alex Cartwright. Alex is the chair of the management department and an associate professor of economics at Ferris State University, and also the principal at Hotel Shift, where they specialize in hotel to apartment conversions. Alex, welcome to the show.
Thanks for that warm introduction, Jonathan. It's a real pleasure to be on a podcast with this title. It was very creative. Everyone's got some kind of very generic real estate title for their podcast, but not you. And given your background, it's even more appropriate of a title. I'm very excited to be here.
I appreciate it. Yeah, I did notice if you just scroll through the titles of the many real estate, it's just pretty much real estate investing 101 all over. But this is here for the mindful approach to real estate investing. I love your background, and with what you know about economics, it can really be a wealth to our viewers. But I told you before, I'm very interested in this hotel to multifamily conversion. I'm also interested in any type of repurposing of assets because I'm sure, as you know, commercial assets are going to need to be repurposed a decent amount over the next several years, and this is just one of the ways. But going back, when was the first time that you were interested in real estate that you can remember?
Was interested in real estate all the way back in graduate school. I went to graduate school in Washington, D.C., which is a pretty expensive place to live. And, fortunate to have a scholarship to go to graduate school, but it didn't afford me a very nice place to live. It really afforded me a very mediocre place with a lot of roommates.
Yeah.
And that's where I really started putting pen to paper on the real estate market. And I was amazed at how you could take the risk to buy an asset like a townhouse, rent it out by the bedrooms on a short-term basis, and be left with more cash flow at the end of the month. And I had no idea that this was called house hacking, but it began a fascination for me on the economics of contract law and how entrepreneurs in some sense are out there creating new types of property rights, new types of contract, buying something for a long term or taking certain kinds of risks, repackaging those risks and selling them to somebody else in either a smaller portion or over a shorter term. And that inspired kind of my dissertation and some academic research on the economics of contract law. So I was always thinking about real estate. But of course, when you're a young graduate student, it's hard convincing a bank to lend to you. So I had to start off with Uber cars. This was right when Uber was becoming a big deal. And so I bought some cars and rented them out to drivers. And so I didn't rent by the day or by the hour. I charged a percentage on their earnings so that incentives were well aligned. And the cars could, in theory, be rented 24 hours a day. And so it was kind of the same idea of buying a house and then renting out the pieces. I was buying the car and then renting it out kind of piecemeal to different drivers. But as soon as I graduated and got a real job, then it was of course time to buy a duplex and another duplex and that was able to just grow the portfolio from there.
Yeah, from an economics point of view, though, was there something about real estate that stood above other potential asset classes for you where you saw a little bit more scale there?
That's a great question. So, as an economist, I take very seriously this idea that if you're going to be an active investor, you need to generate what's called alpha. So, I'm not sure if the listeners are familiar with this term, but kind of the idea is that when you're trying to invest in something, the baseline to compare yourself against to determine whether or not you made a profit is not zero, right? The baseline should be what you could have invested in.
Mm,
And in economics, we've got a Nobel Prize winner that won this Nobel Prize for the idea of the efficient market hypothesis, Eugene Fama at the University of Chicago. And what the efficient market hypothesis says is that public equity markets have got so many participants and there's so much information and those prices bounce around so much that at any given time, the price of Coca-Cola or Facebook or Google or Amazon, that is the right price. That's the efficient price. There's no opportunity for arbitrage there. And so what the implication of that is that if the public equities market is always efficient, in other words, it's always in equilibrium, it's very unlikely that Jonathan Green or Alex Cartwright have got some unique insight that everybody on Wall Street has overlooked.
yeah.
And that we are going to be able to generate some type of rate of return greater than the average rate of return. And then beyond that, that we're going to be able to do that consistently over many years, right? So the key to taking advantage of the power of compounding is, of course, the rate, but you want the consistency.
Yeah.
And so I take that idea real seriously. And I know that if I'm going to not just invest in the S&P 500, I'm going to get off my rear end and go out into the world and work, I want to have a very solid chance of generating true alpha. That is a rate of return beyond a benchmark like the S&P 500. And so I thought, you're going to generate alpha in a market that is plagued with inefficiency, like real estate. I mean, look, it takes time to buy and sell stuff. You've got to be the right buyer at the right time with lots of local knowledge about what neighborhood is a good neighborhood, what asset is a good asset in that neighborhood, right? That's a lot, things move a lot more slowly. And that means there's a lot more opportunity for entrepreneurs. Of course, there's lots of other ways to like real estate. You can buy it with fixed rate debt.
Yeah.
It produces monthly cash flow, right? I can't imagine, at least with residential real estate, what kind of technology is going to destroy demand for it. There's demand for it in recessions and expansions. There's lots of reasons to love it that your listeners are familiar with. But I really like it as an economist precisely because the market is inefficient. It's slow. And that means there's opportunities out there, and you don't have to be a genius hedge fund manager to take advantage of those opportunities.
Yeah, that's something that I talk about all the time. I mean, I think that real estate is decidedly local. So your everyday Joe who lives in a town may be able to know way more about that just particular town and ignore national trends and focus on the town and then become an expert. And that's, leverage for them on the assets that are in that town. One more thing, though, because from the economist's point of view, this makes sense, but does it also help that point of view that you can do value add to real estate? Whereas stocks, it can go, rise and flow with something that a CEO did, but we have no control over that. Even from the tiniest asset in real estate all the way to the largest scale, if you put money into it, you can increase your alpha even more, right?
Sure. And I guess that's right. You've got a lot more control with real estate. So if you're a good operator, you can really force the value to get added there. Of course, the flip side's also true. You can be a nitwit and buy Bitcoin or Nvidia and make lots of money. And if you are a bad real estate operator, maybe appreciation will help you out, but you could also lose money, right? So, but on net, I absolutely agree. And I love that you've got more control over your destiny there. You can be a good operator and get rewarded for it.
Yeah, and I think for investors, when they're newer and they're thinking about investing, and maybe you thought about this when you were younger as well, you're really balancing, like, stocks seem great. I still like stocks, but I have no control, and they're also not tangible. They're just on a screen, real estate, at least you can go see it. You can live there. Buying your own home is a huge investment that can really pay off. But I think people kind of discount that as an investment, because even what you said before, there were people 20, 30 years ago who were using this house hacking strategy. It just didn't have a name. They just thought like, hey, this is just smart business. But there's so many different ways that you can do stuff with real estate to increase your alpha, as you were saying, that I think it really is a reliable asset. But one that I think the more you know, the better.
Mm-hmm. Mm-hmm. And for people getting started in real estate, like I just cannot more enthusiastically recommend house hacking. Like, let's just take 30 seconds to let me endorse that. Like, there's just, you get to be a landlord on training wheels by managing kind of one unit. You get to put essentially zero money down. There's like very little difference between 0 and 3%, right? I mean, that means if this property goes up in value by 3% in 1 year, which it likely will, then you will have gotten your entire down payment back in equity in the first year. And beyond that, most people's biggest expense is their housing expense. If you can take that and cut it down, make it even a 0, to where you can take that money and invest it in whatever else you're going to invest it in, perhaps stocks. So my point is, if you like stocks, the house hack, the real estate can be an avenue to get you more cash flow and autonomy to buy some more of those stocks. And then, of course, you're paying down the debt on the real estate. It's hopefully appreciating. After a year, you can move out of it. Most duplexes just aren't big enough for families or in a school district where you're going to want to live once you're married or at a later life stage. So I beg my students to consider doing that right upon graduation. And I've had very limited success. I think half a dozen students of mine have gone out, and these are my economics students, not like real estate students, right? Have gone out and purchased a duplex. I'm very proud of those that had. Some of them have kind of got sucked into buying a single family instead, which, better than nothing. And now, to your point, at least we have a name for it. It's called house hacking, because a lot of students, they go home, they tell their parents what their professor recommended to them, and the parents are well-intentioned, but oftentimes very risk-averse. This sounds like such a strange investment to them, right? It sounds like you're just buying yourself more headaches. You've got to be responsible for now another tenant, and what if they don't pay the rent? And what if the toilet blows up? And on and on, and all these what ifs that of course are all true with a regular single-family home as well.
And with a condo or with a rental, you still have to fix some of the stuff yourself. I mean, it's about learning about life. I was thinking of that, though, while you were saying it right before. I think parents can be the problem in this early house hacker situation, because a lot of kids in college or graduate school, they need a little bit of help. But it sounds a little bit risky when really it's not. It's very leveraged. If the property's in good shape, you do inspections and your CapEx is going to be okay. You really are just learning landlording along the way. And I mean, when you just think of house hacking, just boil it down, as you were saying in the beginning, hey, you're living in one side, maybe you're even renting the other room in your side, and then you have another side where someone's paying down your housing expenses. It's just genius. I mean, the fact that multifamilies exist and you can do this with a low amount down, it's really unbelievable. I think I didn't really have to think of it that way. My dad was an investor, so I was inside all different types of properties. I didn't really have to house hack as an entity, but I did a lot of things like that. But now I'm just so impressed with all the young people who are in their, even any time in their 20s, that are thinking, hey, this is a great idea, and then repeating the process, which is the smartest thing to do. So did you actually you did a house hack for your first property?
I call it first 3 properties. And I'm still living a multifamily today, just because I can't bring, there are a lot of nice single families out there that I'd like to own, but it's, I guess I'm just not, I'm not ready to, if I'm going to start paying a big mortgage payment every month, I've got to just walk in the home and love every minute of it, right? Like this needs to be a showstopper. And I'm just not ready to pull the trigger on that kind of thing yet, right? I want to invest in the business. And so, I still house hack today. Yeah,
well, I will say, though, in my market, I'm in New Jersey, and I work the on-market a lot. We've seen so many more 2-family homes that are just going with extremely elite renovations. So their rental rates are astronomical. And it's still not the same as a single family house, but these are, it feels more like a really high end townhouse in two sides. And the rents that we're getting versus that are actually beating what the kind of not dilapidated, but okay multis are doing because their rent roll is not as high. So a lot of my clients have been buying more fully done, like the best of the best, and doing way better on the returns. So there are much nicer products going out there in the multi where it used to just kind of be an apartment thing. Have you seen that as well in terms of the quality that's out there for multifamily?
Absolutely. There are newer, bigger units, exactly like you're saying with the two townhouses. And for the people that are hesitant on this, right, think about you're going to get kind of a different clientele with that type of product, right? Like the young person that's very concerned about the dog park and the gym and the pool and that kind of thing, they're still going to be attracted to the more traditional apartment complex or the A-class high-rise, whereas the folks that are renting the townhouse that might be a young family, which might be a lot more appealing to someone that's trying to do landlording for their first time.
Yeah, exactly. And from an economics and investment point of view, for those people who are now renting those higher end, there's not a lot of inventory now. So they're looking at single family homes and they'd rather not pay $300,000 more than it's worth. So they see this high end rental, which they can afford. And a lot of people used to think, well, renting's just throwing money in because, of course, you can house hack. But when inventory is low, you have to really figure out like what's the best option. And this is really a nice hybrid option because you can get that really modern feel in a high end side of a multi and then decide what to do the next year. It gives you a little leeway to choose more.
That's right. And let's just, since you brought that up, let me just kind of dispel this myth that if you're renting, you're throwing money away.
That would be great.
There's no shame in renting. I mean, frankly, there's some people that are probably obsessive, inappropriately obsessive over owning a home and kind of at any cost. And then paying down the mortgage instead of really understanding what all the equity in the walls of the house is doing for them, which is not much, right? Learning to look at the return on equity and not just cash on cash returns. So most people have probably overinvested in their house. And a lot of folks don't recognize that just because your house is often your biggest asset, that doesn't mean that it's your best investment. And beyond that, when you rent, you've just not thrown money away. Like you received a service from somebody else. You could leave at any time, right? And I know we've lived in an economy over the last 5 to 7 years where rent rates have increased, but that's not guaranteed. And the rent could, in theory, go down, and you will not be obligated to pay more. At the same time, if something breaks, you're a phone call away from having it taken care of, and you don't have an unexpected expense. You've got a lot of certainty over what your housing costs are every month. Now, this is not to say that over long periods of time, most people are better off to buy, but it is to say that this is fundamentally an empirical question, meaning you sit down and you measure, here's the benefits of buying, here's the benefits of renting. It's not like out of principle we dismiss renting as throwing money away, right? With these interest rates, and if somebody's only going to be in a major city for a couple years, they're expecting a lifestyle change, they don't know about the neighborhood, etc., it could make a lot of sense to rent versus incur the closing costs and start remodeling and invest in a house you don't want to stay in. So to all those folks out there that are renting right now, but are still aspiring real estate investors, like, good for you. Absolutely no shame in renting. You could be in the right place. You could always rent and be a real estate investor. And there are people out there I've absolutely met. They rent where they live and they happen to own other things where it makes more sense to own and rent them.
Yeah, I think people would be shocked if they actually ran the numbers in kind of luxury-ish communities, at 7 digits and up. In a lot of places, New York City definitely comes to mind with the HOA added on for a lot of the buildings as well when you buy, but also areas like San Diego. If you look at what it would cost right now to buy the home and pay the mortgage, just even with 20% down, you can rent it for way less. So you can actually rent a much nicer place than would this at the same amount that it would cost you to buy it in a lot of areas. So that is a smart efficiency buy, because people tend to, when they think, you were saying before, people get a little bit over obsessed with home ownership, which I also agree with. I love it as an avenue, but it's not always right at the right time. So when people do that, they're forgetting the enjoyment part of it. So they want to own a house so bad that maybe in this market, especially where I am, people are buying houses that they really don't even like, because they think it's going to be better. And then they have to put a whole bunch of money in, which hopefully will appreciate, but it's going to take them longer because they bought high on a property they didn't even love. Whereas you could just rent a property that you're obsessed with, you just don't own it, and then you aspire to go it. That's really great advice and a great point for people to think. And I even did it myself. When I sold my last home, one of my kids was graduating high school and one had 2 more years, and I didn't know where they were going to go after. So for 2 years, I just rented. As someone who's owned, 50 houses in my life, I was renting, and it was smart. I liked it. I rented something very high end, and it was great, great layout for my kids. And that's a really good point, that there's a lot of different ways to use real estate. And sometimes even I think now people may stay in a rental, buy an investment property, because that's going to be a full return, if you buy a multifamily. Or people right now who are still living with their parents and they're like, oh, I'm embarrassed. I'm like, this is the greatest thing ever. If you like it and you can buy an investment property and still live with your parents and you're getting dinner cooked for you, this sounds amazing.
Right.
That's the best house hack, right?
Absolutely. So the moral of the story is, get comfortable running the numbers. And if you are unsure where to start with the numbers, then you find somebody that can advise you in the real estate market. But we tend to make decisions based on principle. It's like, oh, I've heard renting is bad, or I've heard this is good, right? Buying is good, right? When really just gain the confidence and invest in learning what is not that hard to run these numbers and make the decision that's best for you.
Yeah, I like something that you said before. You were talking about getting the income from a house hack or from a rental property and then putting it also into stocks, because I think that people forget you don't have to just have one asset class in your bag. You don't have to just be a real estate investor or only invest in stocks, or you don't have to leave your W-2. You can use all of these things to make a bigger snowball, so you have more to invest in whatever assets that you want to over time. And that's exactly. Really like smart economism, I think, to really figure out, like, you just want to be earning the most amount of money, and you can use a lot of different assets to do that.
Exactly. That's right.
Hey, it's Jonathan, just taking a brief break from this episode to talk to you about Royal Legal Solutions. I had Scott Royal Smith on episode 92 of the podcast. You can go back and check that one out after you finish this episode. And he opened my eyes to how much protection I was losing every year that I didn't activate, build a team, and protect my assets. You can get information about Royal Legal Solutions by using my link at bit.ly/ZenRoyal. And bit.ly is bit.ly/ZenRoyal. You'll find a lot there. You'll find a 30-minute video to watch with Scott. And I can guarantee you what you hear on the podcast is exactly what you're going to hear in that video. So give it a try. I'm down the rabbit hole right with you. Let's get back to the show. Yeah, so along your way in the voyage, obviously you've done the 3 house hacks, you're still in one. When did you get into the idea of this hotel shift? Because this is something I've been really, really interested in. And we were saying before, there's just a lot of commercial assets out there that are going to need revitalization. And this is one reason. So let's talk a little bit about that, how you got into that and where you're going with that at Hotel Shift.
Yeah, sure. So I had kind of graduated into the multifamily syndication space. I knew that was the next step in the journey, if you will. And I had folks that had seen my success doing different house hacks and investment purchases and wanted to place capital with me to do a bigger multifamily project. And so while I was doing kind of very traditional bread and butter value add multifamily syndication, and I was looking for the next deal, I couldn't really find it. Like the risk reward just wasn't there for me. And especially 2020, 2021, when interest rates went straight down and cap rates went straight down as well, I I'm like, hey, the upside here is limited and the downside is larger and larger. The more rent growth that we price in and the higher that we pay on a per unit basis. And so I was less excited about apartments, not because I don't like apartments. There just weren't as many deals.
Yeah.
And at the same time, as somebody who's trying to grow a brand in the syndication space, I thought, how do I differentiate myself in order to attract investor dollars? Everybody that's out, I shouldn't say everybody, but it seemed to me like everyone that was out there is doing value add multifamily investing, right? And that's a great business model. It's a great business. Just like a lot of people buy tacos and hamburgers every day, and there are a lot of taco and hamburger restaurants, and some of them do really well. But I felt like I was selling hamburgers just like everyone else, trying to do value add multifamily. And I thought, I don't want to compete with everyone else because they've got a huge network of investors. They've got the best lending contacts. They're getting the best off-market deals. If I want to succeed in that world, I'm going to have to just be fortunate enough to be at the right place at the right time and get lucky enough times to build my track record. And I thought I need to find a niche, some different strategy. And I was at a real estate conference, which I have huge ROI on going to those, by the way. Like, I don't know that you can go to too many of them. And people ought to set like a minimum amount in their budget every month for what they're going to spend on books and conferences and self-education. The ROI is just immeasurable. So I go to a conference and I happen to meet a broker who told me there's a hotel for sale in my area. And he says, why don't we go look at it? I think it makes sense as a conversion. And I had conceptually heard of people converting properties. Like there's lots of old warehouses and office buildings and things built 100 years ago that have been converted or their use has been adapted. But I had never thought about a hotel conversion for myself as an investment. I didn't know anything about it. And we went and looked at the property. And all I could think about was what a pain in the ass this would be to convert something. Like, got to get permission from the city to rezone. You've got to take over a hotel and shut it down, like take the franchise off and get all the guests out. And then you've got to put kitchens in every room and make sure all that's to code. And then you got to lease it up from zero. You might have to do a year's worth of construction. And of course, you've got to account for the cost of capital during that construction time. But I sat down and I did exactly what we were talking about with the house hacking. You just start putting prices on all of those problems, just trying to, at a very high level, I started calculating out, is this worth it? And long story short is everything I just named out for you, the franchise, the zoning, the construction, all those are absolutely obstacles that cost lots of money, but they are worth solving. They're absolutely worth solving. And there's kind of two reasons why they're worth solving. One, hotels can be purchased really cheaply. And we can talk about why this is. There are lots of distressed or near distressed hotels out there, and their value is not near what an apartment building is. We can talk about exactly why that is. But for right now, just take me at my word that hotels can be purchased pretty cheaply, especially older hotels. And at the same time, there's growing demand for workforce housing. Not necessarily like Section 8 subsidized housing, but just basic entry-level C-class housing. There's growing demand for that. That's exactly what developers cannot afford to build. And these high construction costs, whether that's labor, materials, or the interest rates, they can only afford to build A-class stuff. And with the lower amount of single-family homes that are being built, all the folks that would be homeowners are now renting that A-class stuff. Right. And that's pushing everyone that was in A class to B class. That's pushing everyone that was in B class to C class. C class is where all the demand is. And that's exactly where supply cannot expand. So with hotels, you have the opportunity to buy something at an extraordinary low basis. And then you convert it. The conversion is not just physical. The conversion is financial. Right. Once we get it reclassified zoning wise, and then we lease it up as a multifamily, then it gets appraised as a multifamily. And of course, there's a big payday. And so conceptually, all that clicked for me. And I thought the macroeconomic tailwinds, like for the next, this is not like a 5-year, 10-year trend. Like 20, it's going to be hard to build affordable housing 20 years from now. Okay. It's going to be harder to build more stuff in general as environmental regulations and zoning all becomes more difficult. None of that's getting easier. And I thought, I just need to learn everything I can about how to convert hotels into apartments. I need to niche down on this strategy, right? I need to be 1,000% focused on that. And I need to build a brand around that. And that took a lot of time. It was way harder than I thought it would be because there aren't that many people that have done it. There's no course you can go to. There's no book you can read. Okay. And there are a lot of the insurance companies, like when I was doing my first closing, they're like, well, so is it a hotel or is it an apartment? And I'm like, well, it's both. Yeah. And the banks are like, so is it a hotel or is it an apartment? And I'm like, well, it's going to be both. And then the management company is like, so we're going to run as a hotel and then we're going to run as an apartment.
Yeah.
And I'm like, they're like, well, we don't do that. Right. So it took a lot of filling in the gaps and creating the system and process for how we were going to do this the first time. And we're close to cracking the code on how to get that done.
Yeah. And I mean, this is really a blue ocean strategy to go from something that everybody else is doing to something much tighter. But what I think is really interesting about hotel to apartment conversion that's different from kind of commercial office building is that you have the plumbing in each unit. And that's the hardest conversion when you're doing office conversion to residential is that the plumbing doesn't work because there's bathrooms on the floors. With hotels, you probably don't have the kitchen, and yet unless you're like a La Quinta or something that had the kind of mini kitchens, but at least you have the bathroom set up to be correct. And that's a huge savings over buying like a Toys R Us or, some other big office WeWork place that didn't work out. Am I correct on that that's where a really good savings is?
You're absolutely right. So with office, like you're saying, you usually have the one bathroom in the middle of the floor. The floor plates are typically very flat. So the way you can think of it is you don't have a lot of windows per square foot.
Yeah.
So you can't get a lot of bedrooms out of a big flat plate office space. The other thing with office, everyone hears about the distress in office, and so they ask me about it all the time. My kind of attitude is, why do I want to make this more complicated than it needs to be? Office is not built in areas like hotels are. Hotels are intentionally close to major thoroughfares, close to people, right? They're close to where people are living. Offices are oftentimes in a little more remote location, out in an office park. And the other thing is, even if an office building is distressed, right, you can't just buy it and get rid of all the tenants at the turn of a key. Like,
some have 10-year leases.
Exactly. And then, like you're pointing to, the CapEx is much higher and more complicated. And there are just so many great deals on hotels right now. I'm like, why? We don't need to do office because it sounds cool and sexy. Like, let's just stay focused on hotels. And when the hotel market is totally saturated and there are no more hotels saturated with converters like myself, then we'll go and look at office or schools or churches or old nursing homes is another one. That's probably where I would go to next because of plumbing, exactly like you're saying. But office would be it's at the bottom of my list for now. People have been successful in it, so I'm not poo-pooing them whatsoever, but it seems to me like hotels are much more natural fit. So why would I make it more complicated?
Yeah, I agree with that. And I've seen it. We've had guests on the show who are converting smaller hotels into more all short-term rentals, which I love that idea as well. But that also goes to what you were saying, that there's deals on hotels to be had in all shapes and sizes right now, from very small all the way up. Is there a number of units that is too small for you? Like for you guys at Hotel Shift, what's the basis that you're looking for to be a good acquisition?
That's a great question. So if it was local, I'd be willing to put up with a little bit smaller unit count.
Yeah.
However, I worry more about maximum number of units than minimum. Okay. So if it kind of depends on location. So would I be interested in like a 50, 60 unit hotel? Yes. If it was in a major city and I had a lot of opportunities for property management, they could manage it pretty cheaply. In a small town, right, less so. I'm more worried about keeping the room count at like 150 or less, just because we're typically not combining rooms. I can talk about why that is.
Yeah.
I want I want to provide studios, and I'm not that concerned about unit mix. And so I want to make sure that I'm in a market that can absorb 120 or 150 studios. So 300 unit hotels, right? Those make me way more nervous than like a 50, 60 unit would be. I would say I'm not that interested in stuff that's like sub 50 units, just because there's a lot of fixed costs on to do a deal. But those properties are out there, and they a lot of times are non-financeable. So you can get seller by traditional means. So you can get seller finance on them, and they're in great locations. And so for someone that's looking to do this as maybe like their first bigger deal or on their own with a couple partners, there are a lot of opportunities, I think, in that 20 to 40 room hotel space. The only issue is like a 20 to 40 room motel. It's usually got exterior corridors, so doors that open up to the outside. Like that kind of 20 to 40 unit concrete block box, if you will. Those tend to be more like 40s and 50s construction. Yeah. And the rooms just tend to be smaller. So I'm not interested in stuff that's really like sub 260 square feet. Your hotel room, your standard hotel room is 12 by 24. So that's 288 square feet. That's kind of our baseline. The bigger the rooms, the better, right? That's like the number one thing that I'm looking for when I'm evaluating a property. We're looking for rooms. We're looking, does it already have sprinklers in the building? Which is not a deal killer, but it's nice if they're there. Yeah. The other thing we're looking for is parking. So hotels aren't designed to run at 100% occupancy like an apartment building is. Right. So the hotel may not even have as many spaces as
that's a great point. I think because if you see like a Marriott, they have more parking because they're a conglomerate, but your regular distressed asset, like you said, they're maybe used to being at 50, 60% occupancy. That's what the parking is.
Right. Now, and even if it is like a 1-to-1 parking ratio, sometimes the city will make you have like a 1.15 or 1.2 where you've got to reorganize or add some of the parking. We're working on a deal right now. Well, actually 2 deals right now where we are going to have to expand the parking lot for exactly that reason, because I'm thinking of one deal, hotel in Virginia, 120 unit hotel built with 86 parking spaces. I'm thinking of a Marriott in Texas we're working on right now, 136 rooms, 106 parking spaces. And so that would be a reason where if there's not land available on either side, or if you cannot redesign the parking lot to make it more efficient, sometimes we'll look at, and this one in Virginia we're looking at right now, probably going to get rid of a pool, do some other stuff to be able to expand the parking lot. That would be a situation where we would consider combining the rooms, because then you don't need as many parking spaces.
Yeah, you said before, though, you're not as concerned about the diversification of units. And that's interesting to me, because I really do think like studios should be in huge demand, and they're just not widely available, especially they're usually like a few options. You don't see a lot of these as a mainstay, because that's really giving people who want to get out of a house with family their first opportunity to rent, or someone who can't really afford a lot get an opportunity. That's really in the C area, like you said, that can provide a huge opportunity to let people learn to live on their own, no matter what age it is.
That's right. And so it's not like and let me just say a few things about that, because I've been thinking about this lately, and I've gotten a lot of questions about it, particularly with the studios. Folks will say, well, don't you want a more diverse unit mix? And I understand the intention there. Yeah. Of that question. It's not irrational. Like, don't you want some diversification? And it's like, hey, look, you want diversification. You go invest in some B class and some A class multifamily. Okay. I'm like the Dollar General of apartments, right? I'm not, just because I don't carry Chanel perfume doesn't mean I'm not diversified. That's not the market segment that I'm serving. That's not what my customers want. One layer deeper than that, it's not that I'm obsessed with providing studios. Okay. It's not like I just want there to be more studios on the market. When I get more doors, okay, when I get more of those studios, I can offer them at a lower price. And I know that that's what people want fundamentally, is the low price. Of course, no one says my dream is to live in a 300 or 350, or we've got some rooms as big as 575 square foot, but their dream is to live in a 300 square foot hotel room. All right.
I mean, maybe in New York City.
Maybe in New York City. But But the relevant question is, well, what's the trade-off? What do I have to give up in order to get my 300 square foot hotel room? Well, how about you give up $800 a month and we'll include Wi-Fi, we include cable, we include electricity, and we include water. It's fully turnkey. Everything's taken care of. That number doesn't change month to month. It's $800 a month and it's all inclusive. Now, all of a sudden, 300 square feet looks pretty attractive, right? That's what people want, the pricing. And so the other folks that don't provide as many studios, it's because they're not able to provide them at the price that we are, right? And that's because you can't build or buy multifamily at the prices that we're paying for these hotels.
Yeah. I mean, that just goes to the same blue ocean strategy. It's not swimming in the same direction as everybody else. I mean, and that kind of like in self-storage, I think a lot of people think that diversification, you want a different unit mix because you don't know how much space people are going to need. But this is also not jacking up your CapEx, which is so important by saying like, okay, we're given, this canvas. We're going to stick with the canvas as much as possible because we know there's a demand to get everything done. I think it's really smart. And if I'm a renter out there looking for that type of small property, I'd much prefer to live in an updated, new building that's 300 to 350 square feet than a 550 square feet, maybe with an extra tiny bedroom that's in terrible shape. And I'm going to have to call the landlord all the time. That's not a structured building and it's not as safe.
That's right. So we're exactly right. So if you look at the comparable rents that we're comping to, like we always try and get a solid 20% cheaper than the lowest price one bedroom. That's exactly what you're saying. Maybe it's 600 square feet, but it's got a tiny bedroom. It's got super old cabinets and appliances. It's in a beat up old building. Who knows what your neighbors are going to be like? There's not good customer service. Whereas maybe our unit is smaller, but everything is brand new and we're good managers. And even though we're a lot more expensive per square foot, my argument is that's not how tenants make decisions, right? When you're earning 30, 35 grand a year, and I'm going to take $60 off your monthly expenses by including your internet, and I'm going to give you flat rate electricity, okay? And I'm going to be 20% in the slightly bigger apartment. That's a huge savings that folks respond to.
I think it's, something I was talking about before. I think it's a real opportunity for people to live on their own too, without a roommate, and I think that's important. It's something that a college student could do or somebody with their first job can do and still be like making money on their paycheck. It's a great option. And I think, I mean, when you live in that, first of all, everyone's obsessed with tiny homes now. So what's the big deal? A 280-foot apartment, if it's nice, you're good to go. I think they want the efficiency also. Efficiency is really important now. If you can make it happen. And if you guys are going in to a conversion thinking, well, we want to make this functional, which you are, and efficient for somebody in the modern age, then it's set up like that. Whereas if you take an old hotel room, it's not really efficient. You sit down at the terrible desk. It doesn't really work. You can't see the TV. You're thinking about, well, how can we reconvert this so that it's, a smart thing? One other thing I think it's really important. I can see that the economies of scale exist, like you were saying, because then you can buy more, start out price less. But as you increase your reputation in the area, you can steadily increase rent at a slower rate and then eventually be back to where maybe people thought you would, but you would have already made your occupancy way ahead of them, right?
That's right. That's right. And which is a great point. Like after we do construction, right, then it's all about getting to 90% for 90 days so that we can refi. And I really want to prioritize the occupancy, and we can worry about optimizing the rent and boosting it up in year two, right? Year one is all about, let's get to 90%, let's cash out.
Yeah, is it about a 2-year turn until you hit that 90% from the time that you take over and start construction?
Great question. It really will depend on the property.
Yeah.
Everyone's got a bit of a different story. So, like, for example, we're working on one right now. This was a 250 unit Holiday Inn. The rooms were combined. So I've got really big rooms. Each room is 2 hotel rooms. That's why they're a tad under 600 square feet. And that property when we bought it, had about 58 rooms occupied of people that had been there 4 months or longer. So it was what I call a proxy apartment building. People were living in the hotel.
Right.
We're remodeling that in phases so that we can maintain 60 rooms occupied at all times. So we'll be leasing some floors while we're doing construction on other floors.
Yeah.
And that should take 12 or 14 months total to do.
That helps you on the debt side, right, too, because you have active income as opposed to cleaning the whole thing out.
Oh, yeah. Now, that means you've got to learn something about hotel management, right? Which a lot of multifamily folks are scared to do. And let me just tell you, it's just not that hard, okay? Like I don't want to say you wouldn't want to stay at that hotel, but you probably don't want to. Like, we don't have daily cleaning.
Yeah.
There's not breakfast in the lobby, right? We don't have a vet space. We're not on Expedia. Like, we're prioritizing weekly and monthly stays.
Yeah.
You know what I mean? Now, another hotel that might be is really distressed. It'll be vacant when we buy it. So because it'll be vacant, then we'll go a lot faster on construction there, right? So that will also take a year, 14 months. There's other hotels we might buy an extended stay brand. So closing that a hotel we're probably going to close in about 60 days. It's got kitchens in every room already because the owner was converting it to be a Hometown Studios, which is a red roof extended stay brand. So brand new kitchens in every room. We just need to add fire suppression, sprinklers, and then start leasing. So we might get totally occupied with that one at about the 9-month mark. So some of these, just depending on how much construction has to be done, can be less than a year. Some of them can be more like a year and a half up to 2 years, like you're talking about.
Yeah. So from a limited partner's point of view, if they're hopping into the investment portal with you guys, what's their expectation? Because a lot of times there's the way that it sounds, you're not going to have the same amount of income coming in. You're betting on the longer term, wait till you can refi when you're 90%. And then that, to me, that sounds like a complete windfall.
Right. So on the limited partner side, you got to be upfront with people that this is like a borderline development deal in the sense that after we close, there's not a check coming next month. There's not a check coming next quarter on most properties, right?
Yeah.
This is again, depending on the property, we will want between 6 and 12 months to stabilize it, maybe more like 9 to 12 months on most properties. But one of our like my metric, something that we don't deviate from, is on refi, we're getting everybody 100% of their cash back. And because it's on refi, it'll be non-taxable. And then, so you'll get 100% of your cash back. So you're still, if we can do that in a year, your IRR and your cash on your returns are still huge, even though you're not getting a check every month that first year. And then typically in the subsequent years, it performs just like an apartment building, something like 5 to 7% cash on cash. And you have a nice piece of equity when we sell. But the monthly cash flows, right, after we refi, I mean, the way you think about it, it's all the house's money. You've got infinite returns at some measure because we've given you all your cash back at refi.
Yeah. I mean, for people who know syndications, it's just a different type of model, whereas you put the money in and you're going to get a fixed return. And then, of course, you will make out later. That's still going to be a different scale. So this is just for people who want to be a little bit more patient. And I think probably from your perspective, when you're creating the decks and the prospectus on this, you really have to be clear with them because you don't want to take on the wrong investor who's a pain trying to pull their money out, in the middle, because that just creates a problem.
That's right. Yeah. And typically, just by the nature of what we're doing, it's like a little more complex strategy. I say, hey, I buy at a hotel valuation. Hotels get a much higher cap rate. Multifamily's got a much lower cap rate. We're engaged in the arbitrage between the two cap rates. That kind of strategy just attracts someone that's not a newbie to multi, right? So our average investment size is actually much higher than I ever expected, just because the people we're working with are like, they're sophisticated enough that they understand what we're doing, and they understand they're not dependent on, I need to get money every month in the first 9 to 12 months, right? They're like, I get 100% of my money back a year from now, and then we're good. And that's been helpful, because when I first started in syndication, like, it's kind of everybody's fear, I think, that starts in it. Wow, how am I going to go find all these people? Like, after I hit up my friends and family, then what do I do? And what's been good about the hotel conversion strategy is, since it attracts, just by its nature, since it attracts a little bit more sophisticated investor that's investing a higher dollar amount, right? Like, we don't need 24 people.
Right.
Like, like a dozen people in my first hotel conversion deal. Maybe that might even include spouses. It's not like there's 30, 40 people in these deals.
Yeah, that makes a lot of sense. And I think for people who aren't really, well versed on syndication, this is a great alternative option to start thinking about where you're going. Because for me, like I just started investing in syndications at 53, and now I'm like pretty obsessed in general with them, and focusing on operators. But this is a really nice option to say, because you're kind of you're like betting a little bit more. Like if you invest in a debt syndication, which I like, you're just going to get a standard return, which is boring. I love boring, but I also like to pair boring with something like, hey, a little bit more exciting, which again, with real estate and where we started this whole podcast episode out with, not really that much risk in general. There's always risk if you're overbuying, but because it's a tangible asset and most things are appreciating, at least over the last several years, you have pretty good leverage risk on it. And then if you're doing this with a conversion, you're obviously hoping for what I would appear to be a bigger windfall than some of the multifamily. Because as you said, multifamily that you're buying starts as multifamily and ends as multifamily. Here you're starting as hotel, which is a different acquisition debt, and then finishing as multifamily with a much better out value and appraisal value that way. So you really get like this kind of super compounded return on this, it seems like.
Exactly right. I got to phrase this very carefully, right? Because I don't want to say that like every investment involves risks. I'm not giving up an investment, all the disclaimers, okay? But think about, to get big yield, all right, to get big returns, usually, to your earlier point, usually you got to take on more risk to get bigger returns.
Yeah.
Like you get a little bit lower return in a debt fund, but you're the first one to get paid, right? My favorite part about hotel conversion is we are able to generate such high returns. It's not because we have some super secret value add strategy. All right. We just make them into regular, nice studios.
Yeah.
We get big returns because we're buying in at such a low price, right?
Yeah.
Like that's a big difference. It's big upside because it's big upside and limited downside. Right? Because we've bought in so cheaply. Like the last hotel I bought paid $28,000 a door. And that's for two rooms together. I'm calling that
wow.
$8,000 a door. That's in a zip code where multifamily sells for in the low 100,000s a door, right? Like what I need to rent those things for in order to make money and get investors their money back is way lower than what the apartment guy down the street has to do. Now, that is not to say there aren't risks. Of course, the construction can be long and expensive and comes with uncertainty. But I think risk adjusted, the returns are very appealing when you consider we're getting the big upside because we're buying in so cheaply, right? That is protection, being able to buy in so cheaply. It's protection to the downside.
Yeah, I was thinking about it, just land value and overall building value, because you're not knocking down the building. So your worst case scenario does not really exist. I mean, barring just a complete problem in, construction, or find some environmental issue that hopefully you would find in due diligence. But you're buying a big plot of land at an extreme discount with a building that you don't really have to completely retrofit. You're just going to create things inside the box that's already there. To me, I don't really see a downside on it.
That's right. And worst case scenario. Now, I hope to never have to do this, but absolute worst case scenario, you have an extended stay hotel.
Yeah,
you have a hotel with kitchenettes, and those hotels command a real premium over all other hotels. They don't quite get the multifamily cap rate.
Yeah.
They're like an extended stay America type hotel, let's say in a major Florida city, that trades at a cap rate of like an 8 or a 9, right? Kind of like a C or D class apartment building, because cash flows are so consistent.
Yeah. And again, similar to what your strategy is, those extended stays, your rent is going to be way less than going to try to get into a pretty sweet midterm rental for 3 months. So, I mean, it's really the same philosophy. This has been really enlightening. I'm very excited about it. I like figuring out and learning about these kind of conversion assets, just because I think there's just going to be options out there and we always need to be pivoting. If other people want to learn about this, is the best place for people to go hotelshift.capital?
Yep. that's the place, and sign up for our mailing list. I try to send out cool videos of the projects and the stuff we're up to. And of course, if somebody finds a hotel and they'd like to either bring our attention on it or they just want my help in analyzing it for their own purchase, welcome to send me an email. I think my email's on the Hotel Shift website. Glad to be of help.
Yeah, awesome. Well, this has been a great episode. We've talked about smaller hotels, but we've never talked about this hotel conversion. So this many episodes in, I'm really glad that I got you on, and I definitely look forward to staying in touch. This is definitely a syndication model that I'm personally interested in, because just like, as you were saying, I've been in this for, well over 30 years. I learned it from my dad. I understand where the risk is, and I like to have a bunch of different assets. And it's cool to be able to go into a syndication and know that it works a little bit differently than other syndications. And that's where I think, real estate investing, you just never stop learning. You're always out there looking for experts like yourself to get taught another lesson. So I really appreciate your time today.
Yeah, my pleasure. Thanks for the kind words.
Yeah, awesome. That was Alex Cartwright of Hotel Shift. I'm Jonathan Green. We'll see you next episode. Wait. You have reached the end of the show. This is the part where you're going to get ready to check out, but I've actually changed this part. For over 120 episodes, you heard the same thing. Well, now I've changed it. I've thought about doing intros to the next episode, but I'm going to hold off on that for now. These are my pitches at the end. I've got nothing to sell you at all, but I do want to remind you that it really would help us if you support the podcast in the right way. All that means is subscribing to the podcast so you get it on Monday and Thursday, writing us a 5-star review if you believe that we deserve a 5-star review, sharing it with your friends, and being a participant in the Zen and the Art of Real Estate Investing community. Soon there's going to be a new website launched. Maybe when you're listening to this, it's already going to be out there. That's where we're going to have collaboration. You're going to be able to see a lot from the guest. It is coming soon, and I just want to tell you, from me to you, I don't know how I got here, over 100 episodes. I'm so appreciative of you listening to the podcast and especially sticking around to hear this part. We'll see you next episode.